Hey there, welcome to Financial Market Insights for Traders. I'm your host, Sophia. In today's episode, we're diving deep into a complex but incredibly powerful approach to trading: global macro investing. This episode is designed for experienced traders looking to sharpen their edge, but also for ambitious learners who want to start connecting global economic dots the way the pros do. So, whether you're managing a six-figure portfolio or building your first trading bot, buckle up. We're unpacking how macroeconomic forces like interest rates, inflation, geopolitics, and global policy shape different markets, and how you can turn those forces into advanced trading strategies that actually work. Let's get into it. The core pillars of global macro analysis. First up, the foundation. What are the pillars of macroeconomic analysis? We're talking about interest rates, inflation, geopolitical risk, and policy shifts. 1. Interest rates, the price of money. Interest rates are the heartbeat of macro investing. When central banks like the US, Federal Reserve, the ECB, or China's PBOC change rates, they're sending strong signals to the market. Rate hikes tighten the screws on borrowing, dampen inflation, and often strengthen the domestic currency. Cuts? They juice growth, risk-taking, and sometimes inflation. Here's a practical angle. When the Fed hikes, it's not just US bonds that react. Global capital floods into dollar assets, and emerging markets often take the hit. You see foreign currencies tumble, especially in countries carrying dollar-denominated debt. Traders short EM currencies, or equities tied to those markets. This is the kind of move that separates reactive traders from strategic macro thinkers. 2. Inflation, the hidden tax. Inflation, everyone feels it, but traders use it. It erodes real returns, prompts central banks into action, and creates volatility across asset classes. Traders monitor CPI, PPI, wages, supply chains, and more. When China's factory gate prices rise while the Fed stays dovish, that can trigger a rally in copper, aluminum, and other metals. Commodities become a hedge. This isn't guesswork, it's correlation backed by data. And then there's expectations. The bond market reads inflation like a mood ring. Watch tip spreads. If those spreads widen, the market is bracing for inflation, and traders reprice risk. 3. Geopolitical events, the shockwaves. Let's talk about the unpredictable: geopolitics. War, sanctions, trade disputes, regulatory surprises. These create what traders crave: volatility. Think Russia-Ukraine. That war lit up energy markets. Or US-China trade disputes that sent tech into a tailspin. A smart trader doesn't just panic sell. They deploy advanced option strategies. Long straddles, calendar spreads, volatility arbitrage. You're not betting direction, you're betting on the market moving hard. This also includes watching treaties, trade flows, and alliances. A new trade deal between Europe and India? That shifts the deck for dozens of industries. Stay aware. Be first. 4. Policy shifts, the rulebook changes. Policy changes are stealth catalysts. Fiscal stimulus, tax reforms, ESG mandates, they hit sectors like a tidal wave, and they ripple globally. Let's say the EU ramps up green infrastructure spending. That boosts renewable energy stocks in Germany, but also copper demand from Peru, lithium from Chile. Global macro investors ride this wave across asset classes and borders. And remember, policy and elections are tied at the hip. Election season? It's not just politics, it's macro alpha. A Republican sweep might favor defense and fossil fuels. Democrats? Think clean tech and healthcare. Position accordingly, connecting the global dots. Now that we've built the framework, let's put it to work with real-world scenarios. Case study: China's slowdown in commodities. China slows down? It's not just a Shanghai story. China consumes over half of the world's industrial metals. A cooling property market in Beijing leads to weaker demand for steel and copper. Prices tank. Who else feels it? Australia, major exporter of iron ore and coal. When China sneezes, the Aussie dollar catches a cold. Macro traders short AUD, rotate out of mining ETFs, and hedge with long gold or treasuries. That's the domino effect in action. Case study: Fed moves and global FX. Now zoom in on the Fed. Surprise rate hike? Boom. Dollar surges. Carry trades unwind. Yen strengthens. Euro weakens. Capital chases yield. But nuance matters. If the Fed hikes into a hot inflation cycle, gold might rise despite a stronger dollar. Traders use this signal to shape forex pairs, rate futures, and gold exposure all at once. Macro means multidimensional. Technology plus macro equals serious edge. Let's talk tools. AI in stock trading isn't buzz. It's edge. Quant traders use machine learning to analyze earnings calls, central bank speeches, social sentiment, and make decisions in milliseconds. Even if you're just starting out, algorithmic trading for beginners doesn't mean basic. You can run Python scripts, backtest strategies, and feed in macro data. If you want to learn more, the Crystal Ball Markets podcast is a killer resource, great for people who know trading but are new to coding. NLP is the new newsreader. Bots now parse the tone of Fed pressers before the market even digests the words. It's not science fiction. It's happening. Top tools for macro traders. To win in macro, you need the right gear. Economic calendars that go global. Real-time bond and FX data. AI-enhanced signal generation. Sentiment and news scoring. Full-scale backtesting environments. Use Bloomberg Terminal if you've got the cash. Otherwise, Quant Connect, MetaTrader, TradingView, all solid. The point is to align your toolkit with your strategy. From hedge fund playbook to retail desktop. Guess what? You don't need to be a hedge fund to trade like one. Retail investors have access to ETFs, options, futures, even currency pairs that used to be locked up behind institutional walls. So how do you mimic hedge fund strategies retail investors can actually use? Thematic positioning. Think big picture. Tight money policy. Long financials, short tech. Rising deglobalization. Long domestic infra, short multinationals. And always manage your risk. Use stops. Diversify across markets and regions. Never overleverage. Macro trades take time. Don't get whipsawed by short-term noise. Final thoughts. So let's wrap this up. Whether you're diving into options trading strategies advanced in nature, or just exploring algorithmic trading for beginners, the point is to think in systems. Think in relationships. Think in ripple effects. Because every protest, every drought, every speech by a central banker, it's not just a blip. It's a potential trade. Global macro investing is about understanding the whole board, seeing the forces, timing the reactions, crafting positions with insight. And if you want to keep leveling up, don't miss the crystalballmarkets.com blog. It's packed with sharp market analysis and practical breakdowns for traders who think globally. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia. Stay sharp, think big, and trade smart.